Hello guys, in this video I'm gonna tell you the three most important criteria that Warren Buffett considered while choosing a company for buying its stocks. Before going into the video, subscribe to the channel if you are new here and do like the video. Now let's get into the video. First point is the business simple and understandable. In Buffett's view, investors' financial success is correlated to the degree in which they really understand their investment. Warren Buffett purposefully limits to the companies that are within his area of understanding, and he calls it as his circle of competence. He also suggests that everyone should have their own circle of competence so that they can choose a company that provides them the financial success. He stated that investment success is not about how much you know, but realistically how much you define what you don't know. So the thing here is you should only invest in companies that you completely understand its business model, and you should not invest in companies on the basis of suggestions by others and current trending. Now the common question everyone should ask is why you should do this step. Because if you completely understand the business model of a company, even though if its stock price fell down, you have that confidence to hold the stock for longer time, and eventually it will bounce back because their business fundamentals are very strong. We can take the example of the Coca-Cola company. Basically, the Coca-Cola company buy the commodity inputs and manufacture them into a concentrate and then sold to the bottlers. Then the bottlers combines the concentrate with some other ingredients and eventually they sold it to the retail outlets. So the first point is completely agreeing with the Coca-Cola company. The business of the Coca-Cola company is simple and understandable. Number two, the company should have consistent operating history. We can take the same example of Coca-Cola again. The Coca-Cola company started selling its first product in 1880s as beverage product. Today, even after 120 years, they are selling the same beverage product and still making profits. Periodically, they also tried various products, but their main focus is on the beverages, and in the course of time, they expanded their business to more than 195 countries. Here, in this case, also, the Coca Cola company completely matches the criteria that the company should have the consistent operating history. Another example for consistent operating history is Gillette. Gillette is basically selling the razors and blades for many decades, and still they are the market leaders in that area. Number 3, does the business have favorable long-term prospects? Warren Buffett says if you want high returns from the invested capital, then you should choose companies with high profit margins. So if a company wants to have a high profit margin, then it should have a long-term competitive advantage over its competitors. The company should create a moat that differentiate its product from their competitors. Moat is basically a canal surrounding a castle or fort which is built by a king in order to protect the fort from the enemies. Likewise in business, moat will protect it from losing its market share to the competitors over the period of time. If there is no moat for a company, then their product is no different from everyone else and they definitely compete with others on the basis of price, and then eventually it will affect the profit margins. In short, the company should have high profit margin in order to increase their revenue in the long term, and these are all the 3 points Warren Buffett considered before choosing a stock. That's all for today's video. If you find this video useful, consider subscribing this channel for more related contents.